You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it's time once again for TWIFO. This Week in Futures Options, a program where pretty much the name says it all. We break down the week that was and indeed still is from a futures options trading and trending and analysis and unusual activity and volatility and all sorts of perspectives. My name is Mark Longo from the optionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. You guys know how to get at us on pretty much your platform of choice. A lot of you guys asking, how do I get the old hardcore stuff deep in the weeds way back in the early days of the network, 2007 and that time frame. And you can get all that stuff and more. Easiest place to get all that. We have the full 11-year history of the network available for you. Easiest place to do it, of course, our website or the mobile app. Those are two places where we don't limit you. Other outlets might, like iTunes and other things, probably limit you to 50 or 100 so recent episodes. We go back way to the dark days of podcasting. So if you want to take on that journey, we got the content there for you. Of course, you can always join us live each week as well if you want to get it in your ear holes immediately. I know a lot of you like the on-demand, but for you hardcore out there who like like the live every Friday, 1:30 p.m. Central, 2:30 p.m. Eastern via Mixler. You can also choose to follow us over there. I know hundreds of you could do that, so you get notified the second we go live. Not just with this show, but Vol Views, Option Block, the interview shows we do throughout the week. A lot of other fun stuff we mix in. There's always some surprises in there throughout the week. So grab that link, set it and forget it. Excuse me. And then you too can be notified some fun little surprises throughout the week as we send some live content your way. Of course, however you listen live after the fact, hit us up. Questions, comments, insights, pearls of wisdom. We do like to hear from you guys. And joining me on the program, once again, back from our hiatus, our holiday hiatus, and raring to go, my cohort, my partner in crime, Mr. Nick Howard from Bantix Technologies and the creator of a little platform we like to use around here called Quick Strike. Mr. Nick, welcome back to the show, sir. How goes the striking that is quick?
Oh, we could use another Good Friday holiday today. That's for sure. So, but it's going okay.
Yeah, the market's not liking what they're seeing out there right now. We were joking on our last show, Volatility Views, that maybe it seemed like the market had digested, of course, the trade wars, and it seemed like we were going to perhaps things were calming down a little bit, and of course, as we head on into TWIFO, things are accelerating again. To the downside, most of the major equity indices, at least, off well over 2% right now as we're talking, and perhaps accelerating to the downside. But let's look in the rearview mirror a little bit, Nick. Oh, by the way, we're going to be joined in about 30 minutes, listeners, with a guest for the second half of the show here, so stay tuned for that. But before we get to that, let's start off, Nick, with what's been going on our radar. Of course, this week, the tale has been all about really the trade war. And, we thought for a while most of this was behind us, but a lot of people who were waiting for quite some time to see when that other shoe would drop. That other shoe, of course, being in the form of China saying, oh, yeah, right back at you. And that's pretty much what they said earlier this week, which saw a lot with announcing their own tariffs on a lot of that goods, the 25% tariff on a lot of different items, particularly hitting hard in the ag segment. We saw a big hit across the ags, primarily soybeans. Soybeans is where a lot of our business gets done on the ag side with China. About $14 billion going through there with now facing this 25% tariff, which sounds just exorbitant. We export about 14 billion. Pretty much that means about a third of our crop goes over there to China every year. So they're obviously a big buyer. They have some sway, and yet they're looking to perhaps put a tariff on that, which would really hit a lot of people out there. We saw, of course, futures dipping earlier this week. They were off about 5%, roughly during the session there on Wednesday. That was about a 2-month low. They settled off less than that off the lows during the day, but still, it was not a good day. Then, of course, we're seeing them off again here. And looking here, of course, these tariffs, not, of course, a done deal yet. They still have to be, there's about 1,300 goods. We, of course, announced our own kind of pushback last night, so that set off the sell-off we're seeing there again today. So there's still a lot of decisions to be made on our end. We have about 1,300 goods that they're proposing in the U.S. to put tariffs on. That's about $50 billion worth of products. There's a 30-day comment period before that happens, and that's got up to 180 days after that for the president has to decide whether he's actually going to do it. So this is still in the talking phase, but as we see, the talking is what's really spooking the markets. So, yeah, not a good week. All you guys who've been asking for ags, you're going to get some ags on the show today. This is probably not the way you wanted to get it, but still, you're going to get some ags out here. So let's dive into soybeans first. That's, again, probably the hardest hit spot on the ags in terms of net impact from the tariffs. We're seeing here net on the week only off about 1% here in a little bit north of 1% in the soybeans, about 12 handles, which is not as bad as it had seemed perhaps going into this, but still not a great week for people out there who are soybeans bulls by any mean. Vol, of course, just rally ho across the board as you'd expect in a time like this, 2, 3, 4 handles, depending on where you're looking out here in the term structure, just a lot of vol racing back in to beans as they're very uncertain right now. A huge customer potentially not off the market, but also threatening to put a lot of tax on that supply. So let's dig in here and see exactly. Like I said, we settled out around, looks like about 1032 in the beans, 1033 in that range. And let's see where we set. Oh, by the way, open interest up a whopping 10%, 10.2% this week. That's pretty strong for soybeans. So, and again, there was a lot of action going on out here this week. And of all that action going on out here, it was the May contract that was lighting it up with nearly half, 48% of all the paper this week going up in that May contract. And number one with the bullet, excuse me, were the par puts, the 1,000 puts. So a lot of people perhaps worried about that level, threatening some levels like that earlier this week when we saw the initial rounds of Chinese tariffs being announced. These 1,000 puts doing nearly 26,000 contracts this week. The lion's share going up on Wednesday, surprise, surprise, 13,600 on Wednesday, almost 5,000 going up today. The rest kind of scattered throughout the week. Interestingly enough, it was only slightly biased to the opening, about 400 contracts opening. So a lot of back and forth on this 1,000 strike. You'd think you might see a bias in one direction, size opening or size closing on an event like this, but we didn't see that. We saw pretty much straight size back and forth here on this strike, which is kind of a little bit surprising, quite frankly. And then when we're looking here for other names, we'll get back to May, but we actually also have to go out. You know, all these ags trade kind of on their own schedule, and we also saw the Nove pretty active as well. The Nove 1,200 calls were our number two with a bullet out of here for soybeans, doing 23,275 contracts. The lion's share, again, surprise, surprise, coming on Wednesday, 11,000 and change, 7,600 going up on Thursday, a scant 2,300 hitting the tape today, about 11, almost 1,200 net total on the week opening. So again, a lot of back and forth. So an interesting kind of strangle / risk reversal there, the 1,000, 1,200, 1,000 on the puts, 1,200 on the calls, which is pretty fascinating. Number three is kind of a toss-up. It's kind of a tie. Let's just choose here, stay in the same month, the Nove 1100s. So you got the 1200s, now the 1100s, doing about 21,350. Again, Wednesday leading the charge, 10,600. 5,500 on Thursday, 2,700 today only. So light today on the calls. About almost 10,000, 9,500 opening this week. So a lot of new opening paper on the 1100 strikes. Then we got to go back all the way to May for our number 4, which is the 10.5 calls in May, doing about 21,300 contracts. The lion's share again on Wednesday, 11,000, 4,300 Thursday. Only about 1,800 today, so not as much interest, surprise, in calls today, but a lot more going up on Wednesday. About net closing, actually, 1,500. And then rounding out our top 5 here, we got the 1,100 calls also in that front May contract there, doing nearly 21,000, about 20,900. Actually, the lion's share there coming on Monday, interestingly enough, 9,300 going up on Monday, 5,000 on Tuesday, and the rest kind of scattered throughout the week, about net 12 to 1,300 opening out there. So a lot of fascinating stuff. Now, people have been asking us for a while, Nick, why don't you guys hit some ags? Why don't you guys hit some beans? I was talking to your buddy John Nelson, who's been on the show before. He's big into the beans. He was telling me all about what's going on in beans of late. So I've been getting an earful of the beans of late, and then here they are delivering this week, at least in terms of volume and volatility. What caught your eye out there from a vol and from a skew perspective out there in the soybeans, sir?
Okay, so let's do a little macroeconomic review first, just so I, because I'm not I have like what do they call it, idiot savant, right? So I'm an idiot most of the times, and then I'm a savant every 30 seconds out of every month. So if from a tariff standpoint, if China raises the tariffs on the beans will be more expensive to them, right? There'd be higher price that they have to sell to them. So wouldn't that mean that there'd be less demand coming from them, so therefore the price should go down, correct? Right? So we should see more activity to the downside from an options perspective. That makes sense, or am I off, or has it been too long since I've been out of school?
No, you're right. The price would cost more to the net Chinese consumers because they're costing more to import, so their demand should drop. You're right, and so we should see a little bit of that.
So that's kind of what I always have to like rethink that part of it. So from that standpoint, what's interesting is that the volume on the trade, it's there's a higher bias there's a put call ratio is below 1. In fact, it's 0.8, and it's the same on the open interest. So you would have expected to be maybe a little bit more downside. I don't know, but it appears that it went the other way, and I think a lot of that had to do with the amount of trade in the actual November contract. So that was below 0.5. So maybe on the short term, but even so, there wasn't an over purchasing of puts to calls to this week. So that part I find interesting based on just sort of the textbook definition of what's supposed to happen. From a volatility standpoint, we saw we did have the movement in the future over the course of the week, like you mentioned. And when we look at it just from where we started and where we finished, we started at 1060 and we're about 1034. So we are down. We were down to 985 on Wednesday, right? As you mentioned, when the big announcement came out. But we kind of bounced back to the middle of that range pretty much. So with that in mind, again, we really didn't have a tremendous move or maybe I'm just not privy to what what a big move is and those are not. But it just doesn't. It feels like we've seen these kind of moves enough times. It doesn't feel like it's that big of a move. But we did see from a volatility standpoint, and if we look at the quick skew, obviously the vol was up, and it was a little bit low, so it was definitely up on the week, obviously, but we saw the quick skew where the puts got firmer in comparison to the calls. So we had a pretty wide gap there. The May contract, that gap tightened quite a bit, but that's inherently going to tighten when you're under the 3 weeks. Now we're at 14 days. Last week the calls were quite expensive in comparison to the puts. We expect the smile to get a little bit more natural, but we definitely saw a big put bias, an increase in volatility on the put as we move down. So we had probably a change in the shape of the curve, as well as a move down into some less expensive or less depressed put volatility. So we saw that quick skew. If you're looking at the report, as you can at cmegroup.com/TWIO, and it is open, TWIO or TWIFO. It is open now for clicks and links, so you can get the same stuff that Mark and I are talking about. But we definitely saw some bid in the puts and some offering in the calls, but we didn't see it from a volume standpoint, right? Because you would expect sometimes that you'd see the volume on the one side to sort of drive the volatility. But I think here we just had just a sea change in general in terms of the hello, can you hear me?
Yeah, I hear you. I think we lost you for a second.
Yeah, you know what? When I'm on my phone, because my headset's not working, when I'm on my phone and I get a phone call, Skype gets kicked off. So I apologize for that.
You're too popular of a guy, Nick.
Pardon me?
You're too popular of a guy.
Yeah, no, I don't think that's. It was probably the same marketing call I'm getting for the last 6 months. So, long and the short of it is, we saw puts get much firmer in comparison to the calls, but we didn't see the volume inputs that we would expect with that kind of change. I think it was more of just a general change in market sentiment. And we saw that channel in the quick skew channel tighten, and it tightened much more in the front as you would expect, because that's where the reaction is going to be. But you saw, when we're looking at the put call ratio way out in the new crop, in the November crop, we're seeing that there was a lot more calls traded out there than puts. So again, we probably should spend more time on the ags, but it's always interesting to see if the volumes match the shape of the curve or the change in the shape of the curve and that type of thing. And this time around, as much I would have expected the vol curves to act this way, given that what the expected direction of the price would be with the tariff talk, but the volume certainly, at least, doesn't appear that it supported that same sort of shift in the volatility curve.
Well, we're not done with ags yet, because there wasn't just a tax or a proposed tariff on soybeans. There's also an impact, could have been corn, beef, cotton, tobacco, sorghum, a whole bunch of fun stuff. FCOJ, all that good stuff from the old Trading Places movie. So a lot of things are hitting. So we'll do a little quick touch on. Let's hit a little corn too before we roll off of ags here, just because we know our ag listeners are devoted and they keep asking week after week. So we'll give them what they want. So yeah, it was an interesting week for corn. Of course, and that announcement was made earlier this week. We saw corn futures take it on the chin as well. Excuse me, off more than 2% at that time. They were down, about 380 or so. And here we are now coming into the end of the week here, and net actually up on the week, right around 390 to 400, depending on where you're looking there on the futures, up about 1%, so slightly up here on the week. So maybe the fears were overblown in corn versus soybeans, where it seemed like the lion's share of the impact was felt, at least initially. Looking here, still though a robust week for corn options, up over 8% in terms of new OI, going up about 8.2%. So that's pretty strong for corn. Let's see here where the action was. Again, as Nick mentioned, you could do all this for yourself. CMEGroup.com/TWIFO. And you can get off yourself alt or TWIO if you want to go for the old school anachronistic way. You can do that too. They both work. And let's see where the action was. Number one with the bullet, was in that month, that May contract, doing about 35, a little more than a third of overall volume out there. And it was a lot of volume coming up in these, like we said before, a lot of these names like these even levels. And it was those 400 calls was where the action was. 42,000 of those going up this week. Pretty strong throughout the early portion of the week. 11,300 on Monday, 12,000 on Tuesday, almost 10,000 on Wednesday, 7,400 on Thursday, and then only a paltry 1,600 today. So all that adding up to 42,000. Of that 42,000, only about 4,300, a little bit more than 10% net opening. So just a back and forth slugfest all week on that 400 strike out there in the May corn. Then we fall off a little bit for number two, but not that much, about 10,000 contracts to the 390s. Also pretty much an at-the-money contract right now, 32,000 and change, almost 33,000. The lion's share going up on Wednesday, 11,250, 8,500 on Monday. A paltry 2,400 going up today. Net opening about 5,000, so a little bit more net opening positioning. Less volume, more opening on these 390 calls. Then we got to jump out a little bit away from May, and let's go. The 400 was where the action was this week. Let's go out to July. The July 400 is doing about 25,000 as well. The tie pretty much between Tuesday and Wednesday, pretty close. A couple hundred contracts difference, about 6,800 on one day, 6,600 on Tuesday, and the rest kind of scattered. Again, about 6,500 net opening, so a lot of action there in that contract as well. And then looking here again, dropping off a little bit again as we go back to the May contract for number four, the 380s. So you got a nice call strip going on pretty much each of these months, 400 all the way down. 380s doing about 19,000 and change, 6,600 on Wednesday leading the charge. The rest kind of scattered throughout the week. Net closing about almost 4,000. So a little bit of closing positioning there on the May 380s. And then round out our top five, we've got the first put on our list, the May 370 put doing about 18,400. The lion's share actually going up almost all of it on Wednesday, 14,000 and change of these May 370 puts. Not much really shading the rest of the week at all on this strike. And net about 5,000 openings, so go figure. Some opening positioning on the downside puts when all this news is breaking. Probably not the most surprising detail. So interesting stuff. Let's just scan really quick. Forgot to do this in the soybeans, Nick, for any weird outlander kind of strikes. 4.5s seem to be pretty popular in December. 450s doing about 8,500 contracts there this week. Kind of even throughout the week. A lot of action there. Other than that, it's kind of the most outlandish strike I see in my cursory examination. Mr. Nick, what are you seeing here in your cursory examination of all things corn skew?
Yeah, reiterating again, as you were talking, I was thinking, well, maybe there was more call opening positions on the short side, right? Because we tend to sort of, we tend to think of, at least from my side, I'm thinking of option purchases, right? Or players in a directional sense. But so not necessarily buying puts because you expect a downside, but selling calls, right? So in the end, it ends up being the same type of position if you're hedging them, right? So selling calls and hedging them and buying puts. So that is just one comment I wanted to make about the potential for more upside trading versus the downside. And again, it's a similar. Well, it's even more pronounced in corn. Definitely more calls trading than puts. So and I pay attention to I have a broker that emails me the flow, and he says what direction the paper is. So I'm gonna have to go back and look and see if there's anything telling. I know a lot of call spreads traded in the beans. I didn't pay too much attention to the corn so much, but anyway, very similar. I find it intriguing that we're seeing that ratio be the way it is, and it's not changing much from what the general open interest ratio is. Maybe that's how it is just long term. From a skew standpoint, probably saw similar activity in the front contract. We definitely saw the puts get a little bit of bid, the calls get a little bit offer. But again, like we always say, inside of 3 weeks, we start to see a normalization of that vol curve moving more towards sort of a balanced looking smile most of the time. And but the beans, the front bean contract and the front corn acting similarly. But after that, everything, the skew, the quick skew did not change almost at all across the rest of the contract. So June is steady from what it was last week. So July is pretty similar. September, December, almost the same. A little bit more offering out in the March contract, but there's not even that much open interest there, so we won't even really count that. So not much change in directional bias from a volatility standpoint for the corn. So it's almost like when we had this move up in volatility, we can almost say that it's a pure move up in volatility because the futures contract didn't move, the skew didn't change, so we basically look to have a parallel shift in the vol curve, meaning that it's just a pure bid up on vol. So that's what I'm seeing here, and that seems to be how it is across the board in the corn.
Before we get out of the ags really quickly, we'll touch on our old friend the Hogs as well, because they're also taking on the chin in this. 1 in 4 U.S. hogs sold overseas. Chinese eat the most pork of anybody in the world, so they're a big driver there as well. About 1.1 billion going up there in China for how much pork they're consuming on a regular basis. Pork, an interesting one to watch as well. You guys are always writing in, asking for a little bit of hashtag hog love. We'll give it to you today on the show very quickly. Quick cursory look at the hogs. We all know the hogs don't do as much volume as some of the other, but still a little bit active this week. We saw the futures taking it on the chin, as you would expect. The front month contract off about 5 handles, right around 52. The 2 months out off about 4 handles, off about 64. So right in that range of off about the front month contract off 9%, about 5% for the rest of the contracts, getting a little bit less as you go on out there. So interesting stuff out there. Vol, of course, up aggressively across the board, as you would expect. Open interest actually not up as much as you might think, only up about 1.5%. You think on a week like this, you'd see a lot of new positioning. What was positioning, though, where the action was out here this week, were in the June 78 calls. So a little bit, that June contract is at about a 73 right now. It's not that far out of the money in terms of the calls. Doing about 3,000 contracts. That was number one with a bullet. About 1,300 on Tuesday. Not so much on Wednesday. 500 on Monday and kind of the rest. 600 some odd today. About nearly 1,000 openings. So that was the biggest trade of the week by far. And then you got also the 80s out there, same month, doing about 2,800. So a little bit behind it. Tied with the 70 puts, also doing about 2,800. And both these doing most of their action again on Tuesday for the puts, Wednesday for the calls, 1,062. So a little bit of quick hog love. I know, Nick, you're not a hog guy. Neither am I, but I thought it would be kind of fun to toss that in there for our friends. I just like to use the hashtag hog love. Are you with me?
Yeah, I mean, we should look at it, right? And again, we tend to shy away from it from open interest and volume standpoint, but we do have to address what's going on in the news as well. But nothing spectacular. You mentioned the bid and the volatility, but we don't see the biggest bid that we're seeing is the May contract. That's the smaller open. That's the smallest open interest of all contracts. So I think that one just came on recently. That rolled that one on. They have those intermediate roll-on option contracts. So I'm not going to give too much credence to how that changed, but we did have that one was trading pretty flat prior to this week, and 30% increase in open interest. So, it had a pretty good week from a trade standpoint, but the puts got the most bid over the course of the week there. That's around the 38-day contract. But other than that, we don't see too much of a change in the shape of the vol curves. And again, given that and given that lack of change in shape and given the increase in vol, that's sort of just a bump. Again, like to look at it just a pure bump in volatility.
Speaking of bumps, let's go out there. It actually would be the opposite of a bump. We saw Crude getting some action this week. Of course, it was kind of, again, a tale of two cities, tale of two stories, two narratives out there in Crude with, of course, the tariff, the trade war, lean in on stuff. And at the same time, we had a lot of events out there that were putting, shall we say, some support into Crude. A lot of it on the geopolitical side. We saw some issues with the Saudis actually shooting down a missile targeting one of their new refineries. We also saw some concerns about shipping in that Red Sea area. A Saudi oil tanker came under attack earlier this week as well. So those two things normally would give us a nice crude spike. But then again, we have the trade war kind of overshadowing everything and net driving us off. Some people comparing it, we're seeing broad sell-offs now. It used to be crude was kind of doing its own thing. Now crude gets caught up in that a lot more than it used to. And of course, we see crude net off about 3 handles or almost 5%, about 4.7% on the week there, settling out around 62 level there. So all your crude bulls not quite getting perhaps what you were hoping for this week. OI pretty much in line, only up about 4.5%. That's pretty much about an average week for WTI options. Nothing exceptional going on there. Vol up slightly. We talked about this on the Volatility View show too. People have been excited, looking for crude vol to come back. We've seen it a couple of times where these false starts in terms of crude vol. I don't know if this is going to be the thing that will get crude to carry on. We shall see. In terms of number one with a bullet, where the options action was out here this week in all things WTI, it was, if you guessed the puts and you guessed right around near at the money, you'd be pretty much right. It was the May 60 puts doing 37,000, almost 38,000 contracts out there. The lion's share, I bet you can guess, yes, it was on Wednesday, 14,500 of these puts going up on Wednesday, followed by today, 10,000 and change, as again, we saw some interesting developments coming out of the old trade war. Net closing about 2,000 contracts, actually. So a lot of back and forth here on the 60 strike. People concerned we're going to break it. They're worried we're going to break it, maybe hedging. A lot of interest there on the 60 puts. Number two, going off a little bit here to the 61 puts, even closer to the at the money, doing about 27,000 and change, the lion's share again on Wednesday, 3,500 today, 6,700 going up on Tuesday, about 1,300 net openings. So again, a lot of back and forth. Then we fall off a little bit again to number three, which are the 65 calls. Again, all this in May, listeners. 22, almost 23,000 contracts. Kind of a tie between Wednesday and Thursday, both doing about 6,000 and change. Today, about 3,500. 4,500 going up on Monday, actually. About net 3,000 opening there. Then we'll just do a quick scan here. We also, about number five, we'll take the 62 puts also in May. About 17,000 of those. The lion's share actually coming on Monday, 5,700 of those lighting it up. So a nice little put strip in the front month and some calls to kick it off. Let's go do a real quick search here as well before we bring on our guest to join us for the remaining minutes here of the show. And looking here, we have the 70 calls going up here in June. Also fairly active. So the Bulls were not exactly putting their ammo away this week. About 14,000, almost 14,500 going up this week. The lion's share actually on Wednesday, 5,000 and change. And then we have 60 puts out there doing some We have 70 calls was really where the action was. And let's do some quick cursory looking. I don't see any other crazy strikes. Mr. Nick, what was catching your eye out here in crude before we bring on our guest, sir?
Well, the one thing in the June as well, if you look over in the open interest column, you're going to see that the 80 calls had a big open interest change this week. A lot of that volume
was basically on Monday and Tuesday. So that was a pretty decent increase in OI there. So you got your 70 in that month and also your 80 calls. Catching my eye, I think mostly, as you would, you have a little bit of a move. We really didn't see too much of a vol increase when you start to look at the amount that we were down, just sort of pushing back into the bottom center of our new range. But the one thing I wanted to mention, if you click on the expiration button and add the weeklies, you'll see that the week 2 contract, the LO2J8, which with a week to go, had an 600% increase in open interest, or 2,112 higher in open interest. So that's actually a pretty good sign, Mark. We saw that we see a weekly when there was some activity in that week where the weekly had a really good bump from an open interest standpoint and a volume standpoint. So it traded around 31 or 3,200 and had a change in open interest of about 2,100. So that's pretty good, and that's kind of what we've been looking for.
That's surprising. Yeah, how long we've been looking for that one? A long time.
Right. No, for sure. So that's really what caught my eye the most. I mean, outside of that, we don't really see. Again, you can see for yourself by looking at the 25 delta quick skew column. We don't really see that much of a change in the shape of the curve either. So we had some movement down. So we probably had a little bit of a parallel shift in the vol curve. Not a parallel shift, sorry, horizontal shift. So the curve kind of moved a little bit to the left, and maybe we saw, and we didn't really see much of a change in the shape of the curve either.
Yeah, and perhaps not quite as dramatic of a change as we would think, but we shall see. This was a crazy week for all things crude, and all things for crazy week for a lot of commodities out there. Quite frankly, as we're getting things lined up here with our guest now, listeners. I do believe we are joined, yes, by our late guest. Better late than never here. Second half of the show, we are joined by Todd Colvin, the Senior Vice President over there at Ambrosino Brothers. Todd, welcome to the TWIFO program.
Thank you, Mark. It's good to be here.
Todd, you're also on with my cohort here, Mr. Nick Howard from Quick Strike. Nick, say hello, sir.
Hey, what's up, Todd?
Nick, how you doing?
I'm good.
Well, Todd, as we are wont to do here, I know the clock is ticking, but we want to give you a chance because, as we want to do with all of our first-timers here on the network, why don't you go ahead and give our audience a quick overview of your background and what it is you actually do over there at Ambrosino Brothers.
Well, I've been working in the world of financial futures and options for the better part of a quarter century, executing on the behalf of customers. We deal in options and rates, in equities, and used to dabble a little bit in commodities as well. So we look at a macro range of different products, Fed policy, how they interact, as well as trying to find the best trade, the next trade, whether it be in rates or somewhere else.
Well, Todd, you have auspicious or perhaps inauspicious, I guess, depending on your viewpoint, timing. You're joining us as the broad equity market sell-off is intensifying. And Nick and I just spent the last half an hour or so running down the impact we saw from an options and volatility perspective in a lot of the names being impacted by the trade wars and the tariffs. So a lot of the ags as well as crude. So if you have any thoughts on those, feel free. But I know you like to focus on other market segments. So I'll let you have pride of choice here as a guest here. What would you like us to talk about next? You want to get into rates? You want to get into the broad equity sell-off? Something else catching your eye? What would you like to dive into here?
I'll tell you what, we can bridge the two because I think it's been with the equity sell-off, with the rising levels of the VIX, which is one of the intended consequences of a Fed policy that is now removing stimulus and raising rates. The bond market seems very unaffected by what's happening. We've seen very tight yield ranges. We've seen volatility hovering near the recent lows. The bond market doesn't seem like it's focusing on the equities. It looks like it's focusing more on the data or perhaps even some of the trade problems that we're seeing between China and the United States that are brewing. But it doesn't seem to have the feel of panic that we're seeing in the equity markets. And that, to me, feels like it's a coiled spring ready to bounce at any moment.
Yeah, we're seeing interesting stuff. And I just pulled up, again, listeners, you guys can play along, cmegroup.com/TWIFO to generate the reports for yourself. Just pulling up. We don't get a chance to talk rates a lot here on the show. Kind of an appropriate time. Of course, we have the Fed going off. We have some testimony coming out. We had the non-farms this morning. All of that combining to make make the rates complex perhaps a little bit more active, but it's pulled up the 10 years here on the old quick strike right now. Looks like we're settling off the week off slightly here in terms of the 10 years. In terms of volume, actually open interest actually pretty strong this week, up nearly 8% out there in the old 10 years, with the lion's share. Again, they do some paper out here. The lion's share coming out here in looks like the May 120 half puts doing about 89,000 contracts, almost 90,000. So a lot more than, shall we say, the lean hogs we were talking about a few minutes earlier. Pretty steady, 22,000 today, almost 22,000 going up on Wednesday as well. Kind of the two big days that were driving a lot of the action here this week. Net opening of about 20,000 contracts on these 120 half puts here. Let's look really quickly. All the calls were right in line too. About 89,000 of the 121 half calls also going up here in the front month in the 10-year. Let's look really quickly, get a little bit farther out. Oh yeah, we also have those were the weeklies. I was looking at the weeklies. That's what I was looking at. No, actually, those were May. I'm sorry. I got my reports backwards here as I'm jumping off here to the next one, which are, of course, the June 120 even puts doing about 76,000 contracts this week. The lion's share actually yesterday, 35,000. The rest kind of scattered throughout the week. Nick, I know you come from a rates background. You were a big Eurodollars guy. Anything catching your eye out here this week from a rates vol or options perspective?
No, I mean, I'd leave it for Todd to talk probably more from the expertise standpoint. But I mean, I just kind of look at it generically. I pulled up the weeklies, and again, like we always talk about, there's good volume and good open interest in the weekly contract. So that's always something that we're looking for in all these products in the treasuries and the indexes tend to have the weeklies that are the strongest from a trade standpoint. But as far as the vol goes and the shapes of the volatility curves, we don't see too much going on here. We do see a little bit, we'll ignore the weeklies just because those are under 7 days, and even the May is under 14 days now, so we can't say too much about it. Like we say, the smile always tends to move towards sort of a normal shape as we move towards expiration. But if we go out to the June contract, we saw the calls get offered over the course of the week, and we saw the puts get bid. So we had where the calls were more expensive than at the money at the beginning or at the end of last week, beginning of this week, and the puts were a little bit offered. We're talking about the 25 delta all the time when we talk about the quick skew number. And now this week we have the puts firmer above the at the money, and the calls basically flat to the at the money. So those are the things that really sort of would catch my eye. But I mean, just again, and since I'm not trading, I'm just sort of watching the numbers. I just sort of seen us teeter-tottering back and forth within this market. So I believe that's sort of what Todd might have been referring to when he mentioned how they're unaffected. So Todd, what do you think? I mean, given the fact that we're kind of, we haven't had too much. We see movements, we see reactionary movements, but then we see things sort of come back to where they were from a level standpoint. I mean, you think that's the case?
I think it's definitely the case, Nick, and it's a painful scenario to watch because expectations via options, as you mentioned, Mark, we use option open interest to kind of gauge where we're seeing a lot of the traffic moving. And right now in those June expiry options in the 10-year, we're seeing most of the high open interest going into the 119 puts, which would represent a 3% yield, and then we're looking on the upside at the 122 calls, which would represent about a 265 yield. And we've been hovering in between that range for I can't even tell you how long. And until we break out of that range, until we see a trade either go below 119 or above 3%, or the opposite, below 265 or above the 122 calls, things are going to remain very stagnant in volatility. We haven't had a big breakout move in rates. You have to go back probably to the end of 2017 when we had the Fed meeting and sort of the shift in expectations for 2018. But right here, it just feels like volatility has not been a big event because a lot of the option positioning we're seeing is in those aforementioned weeklies, which aren't really a good gauge for implied volatility. They more are a reflection of realized volatility. And that is not something that a lot of the option products are based off of. So if we look at the weeklies, you're basically targeting a non-farm payroll day. a Chairman Powell speech, perhaps some other event that's on the calendar, and you're looking to probably minimize premium with the idea that you're getting a whole lot of gamma and you're getting a whole lot of what if, sort of that insurance policy behind it. But those don't make for long-term expectations. Those are all based on specific moments that we see come and go pretty quickly.
Since you mentioned the weeklies, that's a perfect excuse to dive right on into the indices. Before we wrap up, I know a lot of our listeners love all things indices, and we are in the midst of a yet another 2% plus sell-off day, at least as we're wrapping up the show here. Listeners, most of the major indices, we'll just pull up our old friend, the E-mini S&P, and see what's cooking on out there. Of course, as you guys probably already know, we just touched on it earlier, spent a whole hour on it earlier today on our Volatility Views program, talking about all things equity volatility. Spoiler alert, it's up. And as the indices continue to sell off aggressively on rumors of this continued trade war, the non-farm numbers, a bunch of other things kind of compiling and conspiring to drag it all down. It did seem for a while like maybe the sell-off was going to abate earlier this morning, and maybe we'd have one of these days where we would end off the lows or maybe close to unched. And then so far, it has not looking that way at all. Ended up just accelerating again to the downside. And Todd mentioned, mentioned the weeklies there. And that is where, of course, where you have to look where the action is out here. If you're talking all things E-mini, the indices really seem to have embraced the weeklies more than just about any other product out there. I don't care which index you're looking at. If you don't look at the weeklies, you're really missing the lion's share of the action out there. In terms of OI this week, it was, shall we say, a robust week in terms of gains of OI with about over 23% increase in OI. Of course, we had some options coming off the board that affects that too, but still a robust week, however you look at it from a net OI change perspective. Vola said already up, so we don't need to dig into that. It's substantial. Let's look instead at what was lighting up the tape out here in all things E-minis. And as Todd alluded to, people are focusing on the near term. It was that week one contract out there in April just lighting it up, number one with the bullet. And it was pretty much all puts all the time. The 2,500 even level puts doing almost 35,000 contracts this week, 12,000 on Wednesday, kind of leading the charge, 8,000 on Tuesday. Kind of light today so far when we ran this earlier, only about 1,200 of these puts on the tape today. So the lion's share coming earlier this week, about 17,000 net opening on this strike. So a lot of new downside positioning. Again, not entirely surprising given the news we've seen coming out this week. And then number two, right behind it, 2,600 puts. Again, a lot of puts lighting it up this week, 31,000, almost 32,000. The lion's share actually coming on Thursday, actually today, 14,000 of those going up, or just about 8,700 on Thursday. The rest kind of scattered throughout the week. Only slightly opening, only about 2,000. So a bit of a back and forth. 2,600, of course, currently right around the at the money. So a little bit of a back and forth battle there on that strike. And then we move out a little bit again for our number three position here, where we have these 27 quarters that are the week threes in April, 27 quarter calls actually doing a total of, well, they were when we ran it to 24,000. Looks like a few more have piled in. So the total now actually of 27,000 going up here on this strike this week. The lion's share coming on Wednesday, 10,600 going up for the 27 quarters. And then the rest kind of scattered throughout the week. 9,000 on Monday, net almost 13,000 opening. So the bulls having a little bit of their say, again, probably coming earlier when we had more. The market was more in the rally ho mode here. Let's just scan really quickly to see, because we are kind of running out of time here, any obscure strikes lighting it up along these lines. Looks like 2,800s also lighting it up, doing about 15,000, 16,000. These coming out here in the June contract as well. So pretty active across a broad strip of strikes, as you might expect. A lot of near-term puts and near downside puts getting a lot of action this week. You know, Mr. Nick, before we rope on Todd here, I know we were talking on our last show, actually, about skew, what's been going on in S&P 500 skew. And, we said in some of the recent sell-offs, it hasn't really performed perhaps as much of a change, much of a development as you might think, given what's going on out there. Have you noticed anything different this week in terms of how skew is really performing? Looking at the quick skew numbers for the E-mini, as well as whatever else is catching your eye out here in E-mini land this week. I think are you muted there, Mr. Nick?
Yes, I'm muted.
There we go.
So you lost all that insight.
I lost all that data. Go back like 2 sentences.
Insight in 5 seconds that you would have gotten. No, I have a question for Todd, so I won't take too long. But what's interesting about the indexes is because if when I turn on the expirations and we have 1, 2, 3, 4, 5, 6, 7, 8 that are 21 days or less. So as much as skew is in there, you really you talk about that vol curve, but from 14 days in, we always say how the vol curve is not necessarily what people think of as a vol curve. At least that's kind of how I explain it. But not that much of a change with the breakdown. We saw the puts are not as firm as they were at the start of the week. So we're seeing a little bit of a tightening of the channel. And that's from June forward. So, June's sort of a little bit unch, but the end of month contract, the April end of month contract, that's in. On the puts are a little bit less expensive. The calls are about the same. So a little bit cheaper puts after this move down, and maybe it's some profit taking, as you might expect. I mean, and the vol is up, but it's not up, tremendous amount outside those front contracts. But one thing I did want to ask Todd before we got pushed off here is I just tweeted out a pricing sheet for the week 1 contract that expires in less than an hour, and it had something that was about $3 out of the money. So I was looking at the right now we're at 25.92, but at the time when I was looking at it, so right now we're at 25.92. So you have the 25.85 is an extract and a downside. So Todd, again, I don't know, you know better because you see more. Here's a put that's got a delta of around, let's see, because I'm in dollars, around a 30 delta, trading for around $93. I mean, that seems kind of expensive now we're talking about, now it's $175. So that's kind of expensive given where we are, right? Something that's only $6 out, that it's trading that much with only less than an hour to go.
Yeah, it does. And what it suggests to me here, Nick, is that demand, while the put skew may be remaining relatively flat, I think that the positioning has been such you got to go back over the last year or so. You've seen put buyers diminish based on the fact that it seemed almost like they were suggesting that buying puts was no longer necessary. The insurance was no longer needed. And we saw puts becoming less and less of a primary first line of defense. And that in itself, I think, would have lessened the put skew, because on a move like this today, 5 years ago, you'd be seeing puts going through the roof. Yeah, there's some profit taking in there, but you would always see somebody reaching for that next level, that now 2,500, the 2,450, whatever it was. You would see them reaching for that, and just not seeing that, at least the way we used to. And I think that the richness of these puts means that there is a demand out there that is not a want to demand, but it is a have to demand. And you have some people bidding there because they have to, not because they want to.
Right. What do we say? What's Sean Smith always say? You buy puts when you can, not when you have to. Right. Yeah. So that's his saying. Right? I always remember that.
Not when the risk manager taps you on the shoulder and says, "Hey, maybe you need some of these." Well, Todd, you've been watching this all week, kind of like everybody else, and kind of seeing the vagaries of the market. Seems like the trade war is behind us. Oh no, it's bad again. Oh no, it's over. Oh no, it's bad again. We're kind of in that bad again mode right now. What is your take on kind of all this back and forth we're seeing in the indices, and maybe what are your clients and customers and end users? Are they freaking out right now? Are they coming to you saying we need X, we need hedges, we need to get short, we need to get long? What are you kind of seeing and encountering out there?
I think there is definitely some angst when it comes to equities, because we haven't seen moves of these types where, we've seen modest pullbacks, but they've always been followed up with big rallies that took us to higher highs. And I think that at this point, as we kind of come to the end of this week, we reached that 200-day. The momentum has seemed to have shifted. And again, I'll go back to the idea that you can say, well, the markets are moving around because of trade wars and they're possibly, but I think ultimately this is because there's a major shift coming in the markets, whether it's from the U.S. monetary policy turning over, whether it's from Europe, they're starting to withdraw stimulus, whether the idea that Japan can do it. There's been this gigantic put in the market that is no longer going to at least be there from a lesser extent. And I think right now the risk assets led by equities, which is where the majority of investor money is on the retail side, they're starting to get nervous. And they haven't had to feel this kind of nervous since 2009. And so it's a new feeling. So I think that right now you're going to see puts come back into favor. I'd be very surprised if put skews don't start to at least start to go up some. I mean, that to me would be very counter to what we're seeing here, is that the markets are selling off and nobody's buying puts. That to me would seem very odd, even in an era of Fed policy that's been zero interest rates for the last 10 years.
Well, speaking of risk assets, we are running up against it, but sorry, listeners, there's so much going on this week. There's no time really we'll get to your questions more next week. Don't worry. We're going to finish up here. Getting to the shiny stuff. You can't really talk rates without talking the flip side of that, which is the shiny stuff, which is gold. All you gold bugs have been waiting for a big move. You got some of that this week. We're seeing gold kind of remembering what it used to do. Oh, wait a minute, I'm supposed to be a bit of a hedge asset. We saw for a while there, particularly towards the end of last year, all this talk about people getting into crypto instead as a hedge. Spoiler alert, didn't work out too well for that one. In fact, let's pull up, see how the Bitcoin is doing here as we're talking off 150 handles. So if you're looking for a crypto for your hedge today, not the day perhaps. Doing decent volume, though, over there on CME Bitcoin futures, doing about 2,500 contracts or close to it, which, 5 multiplier listeners. So that's about 10,000 contracts and change. That's pretty active volume out there on all things Bitcoin. But getting back to the shiny stuff, gold ended up the week here up slightly, about 1%, about 10 handles or so, which is, again, you need this thing to be your risk asset. You go to these in times of terror, and that's kind of what gold was doing this week. In terms of vol, we've said many times that gold vol has been kind of at or near like the 5-year lows. I don't care how you measure. Look at a volatility cone. Look however you like. It's gold vol has been ridiculously cheap, shall we say, for quite some time. Getting a little bit of that back this week, not a ton, but some vol creeping back in to gold. It obviously has a lot more room to run here on the upside, but all of you have been writing in saying, where's the gold vol? When am I going to get my gold vol back? You got a little bit back this week. I think, as Nick would say, it's paying the rent this week between the movement and the vol coming back in. In terms of where the action was this week, again, an OI pretty strong, up nearly 6% overall for the options over here this week. And number one with the bullet, about 42% of the action going up here in the May front contract here, doing, let's see, about 7,500 or close to it of these 13 half calls. So not that far out of the money front month calls, not entirely surprising given the movement we saw this week. About 7,500 of those going up. The lion's share actually on Monday, 2,300 going up on Monday. The rest kind of scattered evenly throughout the week. About 1,700 going up today as well, as you saw some of that movement continuing through today. Then we saw number two, kind of a bit of a tie between the 1,330 puts and the 1,360 calls, both doing about a little bit more than 5,000 each, all again in that front month. The puts, let's take the puts. It did slightly more. They had the lion's share again on Wednesday, 1,400 going up there. The rest evenly scattered throughout the week. Net about 1,200 opening. 1,350 calls doing the lion's share actually on Wednesday as well, 1,500. And doing about, let's see, net opening only about 400 contracts. So not quite as robust from an opening perspective. A lot of back and forth going on out there. Really quickly, let's dive out here to, we have, these are March 2009 14 half calls. Also really active, doing 4,000 contracts, putting them in close to the number 4 spot here for us on gold. Doing 2,000 contracts on Wednesday and then 2,000 again on Thursday. All of that opening. Worth noting, 2,500 of the 17 halves went up on Thursday as well. So maybe the numbers don't really line up, but it is kind of odd that they would have all that going up. And then 2,000 of the 1,600s as well. So maybe a bit of a vertical going up there on Thursday. Again, all that paper opening, 14 half, 17 half, 1,600s, all that call paper opening this week out there in the March 2009. That's not bullish enough for you, listeners. We also saw about 3,200 of the D's 2019, March, and D's 2019 doing about 3,200 of the 2,100 calls. So all you gold bugs out there, that's a good one for you. Net opening, all of that pretty much opening on these 2,100 calls. A total of over 3,000 actually on the week, 3,200. So a lot of action there on those. Todd, I know you watch the rates. You probably watch the metals a lot as well. Have you been watching this kind of trend maybe back into gold a bit? You think gold is performing as you would expect, or is it maybe underperforming as a kind of a risk asset / hedge?
I think that up until this week, it probably has been behaving as I would expect. I think it's interesting you talked about the 1350 strike. I see that for the May options, which expire, I think, April 25th. That is your high open interest strike. We spent the last 2 weeks below 1350, and the previous 3 before that, we were above it. So the market is really kind of using this as sort of a seesaw. It doesn't know whether it's going to go down or up, and it's very rumor driven. It's not really a dollar trade. Yes, there are moments when the dollar declines and we see gold rally still, but it's not been that inverse relationship that we've seen over time. And I think that right here, gold is cheap. I think with everything we don't know, not only about what's happening here, fundamentally, but with a new Fed chairman and policy still very, very fragile, I think that gold could certainly see upside. I think that's why you're seeing some of the interest in some of those longer dated calls. It's just sort of something you can just put out there and put it in a drawer and not worry about it and watch it day to day.
I'm guessing you're not getting as many calls or hearing about as many people these days as you were maybe a few months ago who were calling you up and telling you, hey, I'm switching into crypto away from gold as my risk asset. I'm guessing that's not a call you get as much anymore?
That is not a call, but I will say this, is that there was that week or two of just impactfulness of the cryptos hitting, whether it be from the CBOE or the CME, and they're coming in with these new contracts and all the life it brought. But ultimately, I think that those two markets still have a lot of growing to do, a lot of maturing to do across the board because cryptos are so new. And the facts are that there just aren't enough facts to trade. When you see a contract go from whatever it was, 50 cents to 20,000, the way Bitcoin did, it's very, and then come back to 7. It's very hard to say, well, where's the next move going to come from? And when you don't have an options market to trade around it to kind of show you where the expectations and the demand is being priced, it becomes more of a dartboard type of trade. And I think gold offers you the other side of that. It always has, and it still will be the hedge. I think the ultimate macro hedge for not only rate risk, but also for geopolitical market risks that we continue to see growing.
Mr. Nick, take it home for us here, sir. What are you seeing out here in terms of gold volatility and anything else catching your eye out here from a gold perspective this week? We lost your beginning there again, Mr. Nick.
Oh, another pearl.
Losing your pearls of wisdom one at a time.
Into the ether. No, I think like we've been focusing on the last 5 or 6 weeks when we talk about the increase in volatility. In this case, we have a little bit of a move up, and we have a little bit of an increase in volatility. I think a portion of that volatility increase is based on the fact that we're moving up to the curve hasn't shifted, but the position on the curve has shifted. So we have a little bit of a roll up the call skew, and we definitely have a little bit of a parallel shift up in the volatility. So we have a definite bid in the vol, even though it might not be that tremendous, but we have the increase in volatility just based on the change in the position of the vol curve and the change in the strike. As far as the skew goes, not really too much of a change. Puts a little bit cheaper in the front contract, still about 19 days left. Everything else looks, there's a little bit of a bid in the June contract for the calls from our quick skew numbers. But other than that, not really any tremendous change in the shape of the curve. A little bit, maybe a little bit of a widening of the quick skew channel with puts getting a little bit softer and calls getting a little bit more bid, but nothing tremendously significant. I did want to make one mention about the Bitcoin. I mean, and I find it really interesting. Like SIBO's got about 4,000 traded today. CME, like you mentioned, I think it's around what is it? Today's volume is around 2,400, almost 2,400. So, like you said, 5 times that, you're looking at 12,000. Bitcoins, and the other one you're looking at around 4,000. So, if we're seeing this, we're seeing a big change in where the volume is taking place, and I always thought that the smaller contract would have a little bit of a benefit, but clearly these big contracts aren't deterring anybody from doing anything. So, and to the overall comments about Bitcoin, yeah, we saw the crazy increase from under $1 to $20,000, but as much as it's still fluctuating quite a bit, we're starting to see a little bit of a sideways pattern. Even though the fluctuations are a little bit big, we are seeing more of a contained sideways channel. So once that starts to stabilize over an extended period of time, I can't imagine that we're going to see the run-ups that we saw before, but it becomes more of a useful from a utility standpoint. If the range is not so crazy, then people can actually feel good about making a transaction with it, not thinking they're going to get ripped on it.
All right, that music means we've come to the end. We've already run long, listeners, but there's so much to get to this week. A lot of stuff popping off in the old markets there this week. We covered covered a swath of ags. You guys have been writing in, asking for more ags. We covered a bunch of them this week. Even threw a little bit of hog love your way. Got into some crude, got indices, got the rates, got a little bit of shiny stuff there towards the end. Even touched on, you can't avoid it, even touched on the crypto there towards the end. So I don't think anyone could have any write-ins for any asset classes that we missed, unless you're one of those out there beating the drum for, shall we say, dairy. Then we did miss that one this week. But other than that, we hit on, I think, most of the key essentials on this very tumultuous trade war week. But before we go, let me go back around the horn. Todd, we'll start with you as our guest. If listeners like what you were talking about, they want to hear more, maybe they want to learn more about what you guys are doing over there at Ambrosino Brothers, where should they go? What should they do?
You can get me on Twitter at TJC1539. That's where I hang my hat.
There you go. TJC1539, you said?
Yes.
There you go. TJC1539. Throw the man a follow and see what he has to say when he's not coming on shows here like Twifo and Nick. You guys are always cranking out interesting new upgrades and tweaks and tools and reports for the Twifo and for the Quick Strike faithful. What can they expect coming out of you guys this week, sir?
Let's see. So soon, I think last week we finally released that comprehensive options expiration calendar, futures and product calendar in general. That's on the CME Group website. You can see it out there. And prominently on the CMEgroup.com/quickstrike page is the new strategy simulator tool. So that's been out there a few weeks, getting some good feedback on that. And then coming soon will be integrated economic calendar, where you'll be able to see events from 8 or 10 countries, and then the high impact, medium impact, low impact, and then CME particular events that they're trying to earmark. You'll see those in sort of a weekly calendar format with all of an asset class's expirations expiring on that day over on one side as well. So you have you'll be able to go to a single place to see if you want to play in a particular event or for a particular event, what options are available to you there. And then, of course, other stuff coming out. There'll be some interesting event volatility stuff coming out pretty soon, some block trade alert stuff coming out pretty soon, and then also all the new tools that we are bringing into the fold. And stay tuned. This quarter we'll be working to release with the CME some historical volatility tools where users will be able to get volatility curves for a very extended period of time. You'll be able to purchase those and look at charts and that kind of thing. So a lot happened in this quarter. So keep your ear on the show to hear what's going to go on and when it's going to be released.
There you go. Check it out. Easiest place to find all that stuff. A lot of places you can go. You can search for cmegroup.com/Twifo, get access to the reports, or head on over to bandtix.com. Click on the sign up for Quick Strike link. Or while you're over there on the CME site, make sure you check out that strategy builder we were talking about before, too. All sorts of cool tools heading your way over there from Nick and his team. And on behalf of myself and Nick and Todd, I want to thank all of you out there for downloading, streaming, subscribing, for sending in questions. Sorry we didn't have time to get to them this week. We'll get to them more next week. And we'll see you right back here next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by Quick Strike, options pricing and analysis software. Quick Strike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. Quick Strike has you covered, with market data reports ranging from open interest to the term structure of volatility. Quick Strike is the perfect addition to your trading toolkit. Learn more about Quick Strike at bandtix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.